What are the questions you could ask? How do you interrogate somebody else's numbers? You have to feel a little bit comfortable doing that. Um, so first, market rate housing. Most of the housing in the United States is market rate. It's built by developers and sold or rented at whatever the market will bear. And there's a lot of variety. We're going to talk about sort of how does the development process work, and then what motivates developers? How do what are they looking for, and why do we care about that? Like, why are we trying to motivate developers? Um, the first thing is I want to start is sort of why bother with this. So, um, if you're a housing justice advocate, you want housing, you want deeply affordable housing, you want housing for certain populations. Um, there's some truth to it's enough to just demand what you need. But what happens in most cities in America is that we don't get the housing that we want. And we have this problem where when, the city says we're going to zone for a certain kind of housing or whatever, and developers come in and they say, oh no, that's not feasible. And we sort of have to take their word for it. And the the truth is that nothing gets built that isn't feasible. I mean, it's sort of an obvious truth, but if there's not the money there to pay for something, then it doesn't get built. And when there is the money, sometimes it still doesn't get built, but sometimes it does get built. And whether we're talking about affordable housing or market rate housing, there's the same sense in which we can ask for whatever we want, but if the thing that we want doesn't happen to pencil is the term that developers use. If the math doesn't work, they can't do it even if they want to do it. They can't get the money, they can't build what they want what we want them to build. But at the edges, there's all sorts of choices that can be made where we can demand something and they can do it. And they might have to give up something else in order to do it, including their own level of profit. They might need to make less profit. Um, Within this small range, we have the ability to change what gets built and who it gets built for. But that range is pretty small because of some of the things we're going to talk about. But like the way that financing works is the way it works, and so we can only push it so far. So we have to understand a little bit about where that limit is in order to ask for things that we can actually win, because you can have the strongest fight in the world. If you're fighting for something that's not possible, you can't win it. And so we have a lot of examples of coalitions that have pushed for housing policies that were not feasible and couldn't be feasible, and others where they're big wins because people pushed for something that was hard but doable. So that's why we're trying to focus on feasibility so that our asks are, something we can actually win. Um, and when we ask for things that we can't win, what we get is like vacant lots and parking lots and old buildings that sit empty because no one can redevelop them. And so we what we want to push for is a system where we're changing what's possible rather than just asking for the impossible. Um, so the other thing that I find a lot of times, the advocates, particularly advocates for low-income tenants, uh, are very comfortable, and I have been in this role myself, very comfortable seeing developers as sort of like cartoonishly evil. And I've had as part of my job for the last decade interviewing developers on behalf of community groups or cities and asking them kind of about how their job works and what makes them tick. And it is true that a lot of developers just don't care about a lot of things that the people who are tenant advocates often care about. Um, but they're also often locally controlled small businesses. They're often deeply enmeshed in the local community. Some are huge global real estate firms, but some are like mom and pop businesses with three employees, and they're building housing. And housing itself is a need that we need housing, so somebody has to do it. And for some reason, we tend not to cartoonishly vilify the people who build, furniture or other products that we all use. But on real estate, because there's this political fight about who it's going to serve and rents, and because it's such an important part of people's quality of life, we end up with sort of us versus them attitudes about real estate. And I'm not suggesting people should stop doing that. I'm suggesting just for the next 30, 40 minutes, set that aside and let's just think about like what would it be like to actually be on the other side of that table, and what in order to understand what's possible, we sort of have to understand what's motivating the people who are doing this thing, because at some level what we're trying to do when we try to start a social housing program is like get somebody to do the kind of thing that we've wanted done all along. So who's that somebody going to be, and how do they think? Um, so the first thing that any real estate developer will tell you when you start asking about housing is like it's really expensive, and it's just been getting more and more expensive. And so I'm going to use this example through this presentation of a apartment building, and I'm gonna say this is a, fairly dense building. It's five, maybe 4 or 5 stories, with apartments and brand new construction, and it costs something like $400,000 a unit to build. So most of that is the general contractor gets paid, for the lumber and the siding and the windows and the labor that goes into building the building. Some of it is interest on the big loan we have to borrow to build that unit. Some of it is fees we have to pay to the city or the county for permits and entitlement on the project. We might need an architect and lawyers and other engineers. And then a big piece is always going to be the land. We had to buy the land. So if we're a developer, we have to come up with all this money. We have to pay for all of this before we even get any rent. And over time, if the costs go up, it might be more than we expected, right? When the cost of lumber goes up, our construction costs goes up, and we're doesn't mean our rents are going to go up. Um, the money for this comes from this stack. We call it a capital stack, right? There's a set of different sources. And while every developer is a little bit different in how they finance their projects, when you look at apartment buildings, they tend to have these three separate buckets of money, and they almost all have something in each of these three buckets. And the biggest bucket at the bottom is a construction loan from generally a bank. Lender, sometimes an insurance company. Lender goes and gets a construction loan for most of the cost, but the bank doesn't want to lend $400,000 on a $400,000 project. They want somebody else to share the risk. So just like when you buy your house, you have to have a down payment. The developer has to put money down too. The bank limits how much of the cost they're going to cover, and the rest comes from equity. And in the olden days, the equity was the developer's own money, and the bank did what they did, and the developer put down the rest, just like a homeowner with their down payment. Nowadays, they split that equity into two parts. The developer puts in some piece of money. In this example, I have them putting in $20,000 per unit. And then they go to the capital markets and they find an equity investor. And I'll talk a little bit about who that is, but they get maybe $90,000 per unit from that equity investor. And so they have to pay the equity investor a lot to get them to take that risk. They're taking a riskier position than the bank. They're going to maybe lose their money first. The bank's got the protection of somebody else's money is in here and it's going to get, if money's getting lost, it's going to be somebody else's money first. So we have this kind of capital stack pretty typically. Sometimes really credit-worthy developer can borrow more than this from their construction loan. And sometimes a really cash-strapped developer, that doesn't have a lot of track record might not even be able to borrow this much on the construction loan. It might have to come up with even more of the equity out of their own pocket because the bank sees them as risky. That also changes over time, like how much the banks are willing, how much risk they're willing to take. So this is that same numbers here. If the unit costs $400,000 and there's 50 of them in the building, that's a $20 million building. We need $20 million. So that bank loan, it's not $290,000, it's $14.5 million. And the developer equity is $1 million, and the equity investor money is $4.5 million in this example. So the developer's putting down 5%. They're getting 23% here from the equity investor and 73% from the bank. And these, wind up being big numbers. Um, so one of the big things that drives what's possible in when we're trying to push market rate developers to build is the interests of these equity investors. If we need somebody to put $4.5 million into our project, that's somebody, and that money's going to be at risk. Like if our project comes in over budget or whatever, if it doesn't get built, they lose that money. They're going to have a real interest in what we build and what kind of thing we build and what it looks like and how much parking it has and particularly what the rents are and how affordable it is. They are very conservative, these equity investors. And one of the reasons so much of the rental housing that's getting built in the last few decades looks so similar is that these equity investors are familiar with the projects that have paid them back properly in the past and the ones that haven't. And if you propose to do a purple building, they will say to you, you know, half the time when someone paints their building purple, it doesn't rent. Why not gray? We like gray. And you end up with gray buildings everywhere because the pension fund that finances likes gray. And the same people work in these different institutions. So there's a group think. Sometimes it's based on these are real limits. So parking, for example, a lot of cities want to see developers for sort of green reasons build less parking and encourage transit and walking and biking. Um, Equity investor thinks to themselves, if they don't build enough parking, we might not be able to lease the units and I might not get my money back. So I'm going to require them to build parking. So the equity investors have a lot of power. And they tend to be pension funds, insurance companies. Sometimes they're private equity funds, the sort of hedge funds. Um, Sometimes they're REITs, which is just basically like a mutual fund that's been set up specifically to invest in real estate, and you can sort of buy in on the stock market. But they're real estate specific investors often, and the largest source of money is pension funds. Um, there was a time when this would be doctors and dentists. This like if you were a developer, you'd put down your 5% and you'd go out and you'd talk to some of the like local dentists and you'd get them to pool their money and that would be your equity. Now there's like this sophisticated set of companies that exist and are looking for deals. And so it's just easier to go to them and get the money. On the debt side, this is mostly banks, insurance companies. Sometimes there are government loans. So you can get loans through HUD or FHA. Fannie Mae and Freddie Mac sometimes are financing multifamily buildings with mortgages, um, mostly the permanent mortgages. And these are very unsexy and unsophisticated. Like they do the same kind of thing over and over again, and they're not driving what gets built as much because they just have simple terms and they don't spend a lot of time looking at the designs of each and every building. Because remember, they're only doing the first part of the money. And so they're sort of counting on the equity investors to be pushing for it to be gray. They're not as concerned about what color it's painted. And that's just, an example. Um, so one of the things I think is really instructive is to imagine since most of this equity, this sort of middle tranche of investor equity is very often coming from pension funds or some similar type of entity, what that's saying is actually the money that's going into these real estate projects is actually working people's money to begin with. This is somebody's retirement savings. And it's like one thing to sort of bang your fist on the table and say, developer needs to build with no parking. We want no parking, or we want LEED certification, or we want more affordable housing. But if your retirement savings are invested in the building, how would you think about this? Like what you've got, $90,000 that's going to go into a brand new building, and we're going to spend a total of $400,000 to build an apartment. we don't know what the rent is going to be by the time we're done, and we also don't know how much it's really going to cost. We think it's going to cost 400,000, but it could cost 430,000 a unit. Um, there's a lot of risk, and the question is, why would we want to put our retirement savings into something that's risky? And if we could instead, put it in a savings bond or buy treasury bills or even put it into a mutual fund and on Wall Street, and earn a sort of not totally safe, but safer return, like why would we take our retirement money and put it there? And if the building goes bad, we might not have a retirement. Like we might not be able we might have to work longer. So the reason is going to be because we're going to make more money, right? Only reason we're making our retirement savings available to this real estate developer is because they're going to pay us more money than we would have earned in the stock market, or more money than we would have earned from a treasury. And so, how do we know that? And what do we have to do to be sure of that? Because we wouldn't want our retirement money to go in and not earn more money. And we might not want it to go in and earn more money. But if we're going to do it at all, it's going to be because we're going to be able to retire earlier because we have more money coming in. Um, so the way that these investors think about it is based on the net operating income in the building. And so we have rents, and this is just, for example, one unit in 1 year, we might get $33,000 in rent. We're going to have some vacancy every year, so we're not really getting $33,000. We're getting, let's say we have a 5% vacancy rate. We're going to lose some money to vacancy. And then we're going to have to pay to operate the building. And this is everything from insurance to the property management company to repairs, like snow removal if we have to remove snow, like all that stuff that goes into operating the building. And so that what's left over at the end of the year is $20,000. So we have 33,000 maybe coming in, but we all really only end up with $20,000 after we paid for everything. And that 20,000 we call the net operating income. And every building has a different net operating income. And it's kind of like a key number for thinking about how much cash is coming out of a real estate investment. And what we can do with that number is we can calculate what's called yield on cost. And this is just one way of thinking about, is this building profitable or not? And if we have $20,000 in net operating income, but it costs us $400,000 to build the unit, that's a yield on cost of 5.2%. And what that translates to is if you took $400,000 and put it into a certificate of deposit that paid you 5.2% annual interest, you'd have $20,000 annually. That's just all it is. You're going to get this, the operating income from our building equates to about 5% growth on the cost of building the building. That's the yield on cost. And investors use this number to quickly compare different buildings. So I might be a pension fund and I might be sitting around looking for somewhere to invest my money. And one developer might come in and say, I'll give you 5.2% yield. And another might say, I'll give you 5.5. I might like 5.5 better. Are going to get more money every month in exchange for less money up front. So that's how I'm quickly comparing them. And there's a market. And the market right now is 5 to 5.5% yield on cost is a feasible building. If you're looking for an investor and you can give them that you can show your building has that kind of return, they're going to look closely at your deal. Now they're going to also look at a dozen other metrics. They're not just going to write checks based on this one number, but this is the quick and easy way to compare two different buildings. The other thing that you might think about if you're the developer is not the annual cash flow from the building, but rather the profit if we're going to sell it. So a developer might there's two different kinds of real estate developers. Some are buy and build and hold, like they're going to build something and they're going to hold on to it forever. And they really care about that cash flow and that yield. And others are building it and then they're going to sell it as soon as they can. And as soon as they can is usually after it's fully occupied. Once it's all been leased up and people are living there, and we have a couple of months of stable rent, With low vacancy, we've proven the value of the building, and then we want to turn around and we want to sell it, get our money back, take our profit and walk away and do another deal. And we're going to sell it to a insurance company or a pension fund or a REIT, and they're going to then be the long-term owner. Um, so there, what we're looking at is what did it cost to build? How much are we likely to be able to sell it for? What's the difference between those two things as a percentage of that original number? So we put 400,000 in, we sell it later for 450,000. This is per unit, right? 400,000 per unit. We sell it for 450 per unit. We have $50,000 in profit for every unit. 50,000 is 12.5% of 400. So we had a 12.5% profit on the sale. Now, this seems like a completely different number than the other thing. And I'll just point out that if you are interested in the math, when you think about what's the future value of the project, how much is that insurance company or whoever going to pay you to buy it from you? Well, they're going to be looking at the net operating income. So these two numbers end up moving together. The higher the yield, the higher the profit at sale as well, because the sale price goes up when the NOI goes up. So when if more income from the building coming in, somebody's willing to pay more because what they're really buying is not so much the building as the cash flow that comes off the building. They're wanting that cash flow, and the more cash flow there is, the more they're willing to pay for it. I hope this is making sense. I wish there was.
Yeah. No, it's I was going to stop you, Rick, for one
Yeah.
second and see if some folks just joined. So if folks have questions, private message Cade. And we'll be able to see the questions. But what I think would be helpful, send a sign of life, send a reactions. You can do those like um, thumbs up or heart or choose your reaction, send a sign of life. Let us know if this is all making sense. I see, let's see, Matt sent a heart. I see some thumbs up over here from Taylor and Rita and John. Okay. I'm looking at you, Bethany, Courtney, because I can see your face. Okay, thank you. Sorry. We just want to make sure people are alive and listening and giving folks an opportunity to just like interact for a second before we move on, because it's like a lot of numbers. But if there are no, I see no questions yet, Kate, am I right?
Kate's got
There are a
one.
few that would make more sense at the end.
Okay.
And yes, a few people asked if it's being recorded. Yes, we are recording right now. The chat is not recorded though. So feel free to ask whatever that will not show up on the recording, but the presentation is being recorded.
All
And
right.
Kate, let me know if you see questions that are like going to be easier just to answer as we go. I'm happy to have you interrupt me with like, oh, someone wanted to know why it said that on that slide.
I got you. We'll do.
Yeah.
All right.
Um,
Back to you, Rick.
yeah. So the question, if this is your retirement money, and you could take that $90,000 a unit and you could put it in a treasury bond and earn 1.5% per year. Or you could put it in the stock market, which has averaged about 8.8%. You know, sometimes it's way more, sometimes it's way less, but over the long 10-year plus periods, it's pretty typically, in that range. Um, how much do you need to earn to decide to take your money out of the stock market or out of treasury bonds and put it into this real estate project? And just to remind you, so the real estate project has uh, a risk that maybe it won't get approved. We're going to spend all the money on the engineering and the construction drawings, and we're going to run into some problem that the city won't approve the building. Or the market risk is, well, rents could drop while we're in construction. There could be, for example, a global pandemic that causes everybody to move out of town to some more rural areas, and rents could fall. Or there's a cost risk. After we start building, there's new tariffs that get imposed. And suddenly the windows that we were counting on are twice as much as we thought they were going to be, and we have, 2,000 of them. Or there's a construction risk, and one second, Kate, there's a construction risk. We could get underway and we could just run into a problem on the site that like there's a soils problem and we need to spend a lot more money. I just talked to a developer yesterday after they started building their project, they learned they had to build a seawall. It's not going to be a problem in Nashville, but $10 million seawall, only way to continue building their project. And then, act of God, I guess the pandemic might fall in that hurricane, fire, whatever. We have a project in the Bay Area that burned down twice during construction. Burned down, built it back, burned down again. Insurance paid for most of that, but probably not all of it. So these are the risks. So how much do you need to earn in order to be worth putting your money into a deal with those kinds of risks when you can get kind of steady returns on the stock market? Kay, did you have a question?
Yeah, a few folks or one folk messaged and said that the volume was not working and wanted to check if it was working for other people. If you can hear, can you just again give a quick thumbs up, make sure it didn't cut out for anyone else? Okay,
Oh,
cool. So the person who messaged me, I will message them back. All right, thank you. Just wanted to make sure the volume was working. Thanks.
great. So the way this capital stack works for market rate development is that the banks put up most of the money in exchange for relatively low returns. They have a safer position, and so they get less interest. So, a bank loan will be used to be 4 or 5%. Now it's 6 or 7%. For high interest, it might be 10, but like it's relatively modest compared to as we go up, these pension funds, the hedge funds are getting routinely 20% annual returns on their money. They're not interested in doing deals where they don't get that kind of return, and that's because they're taking risk and they could put their money somewhere else at lower risk. And the developers will often expect 15 or more percent return themselves. And so you have this sort of high cost equity money and lower cost interest, on the debt. And the blended, if we say there's 12.5% profit, like we're blending those two. Because we have less money from the equity, we put more of the profit to the equity investors. They get a higher return on their money. Like they put less in, they get more money out. They get a higher rate. Um, the market dictates these returns and they fluctuate. There are, you've all seen how there's like boom and bust cycles in real estate. And the main thing that drives the boom and bust in new residential construction is that there are periods of time when there are equity investors that are desperate to put money into new housing developments, and they're willing to take relatively low returns in order to get their money on the street, they call it, get their money out the door. They want to be in projects. And then as soon as somebody has trouble leasing their building, in Nashville, all the investors start saying, well, no, we're not willing to do it for, 18%. We need 22%. We need a higher return. So it's risky. It's market's getting risky. Things are happening. We need a higher rate. And as they all shift to higher rates, all the buildings that would have moved forward at 18% now have to pay 22% and they can't, it doesn't work. And so it's the sudden shift of the expectations of these equity investors drives the sort of all of a sudden real estate dries up and nobody's building anything. And so we end up with these gluts because everybody got a whole bunch of money and they just started doing everything. And then it all goes away and there's no money and nothing can get built. And then I think it's bad for the, cities to see booms and busts like that, but it's built into the nature of the way we finance these projects. And it's one of the reasons that a social housing type of program might be a better approach because if we didn't have to cater to the whims of these equity investors, we might be able to build even in the sort of slower times. And that might mean we can get cheaper land. It might mean we can keep the contractors working when they would otherwise be out of work. Like there's a lot to be said for smoothing everything out. Kate, another question?
Yeah. So someone asked, when you say that the market dictates these returns, the person asked, aren't private investors determining their profits somewhat arbitrarily, i.e., not that it's determined by cost or demand necessarily, but a certain like profit that they're setting? Can you speak to that a little bit?
Yeah, that's a great question. I think that that's true, but but what it means is different than what you think when you hear someone say that. when you say setting their number arbitrarily, what you picture is someone just sitting at home and saying, I would like 20% return on my money. If I'm sitting there and I'm profit motivated, like that's really the only thing I care about. And let me say this, nobody really only cares about profit. But if you're rich or you're a bank or a pension fund, you have all kinds of things you care about. But what you do is you put your money in somebody else's hands, and that somebody else then is obligated to only care about profit. And so they're going to report to you what return you're going to get, and you're going to tell them, get me the biggest, most you can get. And so let's start at we'd like 100% return on our money. And I say, I've decided arbitrarily that I would like 100% return on my money. I'm going to go to Nashville and I'm going to look for developers that can offer me 100% return on my money. And I meet with you and you're a real estate developer. And I say, I want 100%. And you say, Prudential will do it for 19.5. Now I have a choice. Do I take 19.5 or nothing? So I may have arbitrarily decided, but the market is 19.5. Cade can get 19.5 from more than one investor in town. I have to do 19. I might say I'm not willing to do it for less than 20. And then that might, if that's true, that means I'm not going to get any deals until the market gets to 20. And, I might choose 20 as my point, not arbitrarily, but because I have this other investment opportunity that pays me 20. So why would I take my money out of 20 if and to get 19.2? I'm not willing to do 19.2. It's not arbitrary. It's because I can get 20. And you, Kate, aren't isn't you're not willing to take 20 because you can get 19. That's what it means to say the market sets it. Everybody has their own set of options, and the best one is the one they choose. And when everybody chooses the best one, the market narrows down on a single number, and everybody pays that exact number. And it's a little different because there's really only a few investors and there's really only a few developers, and so it's not a very good market in that sense. So I might actually agree to 19.5, even though I probably could have gotten 20 if I just talked to somebody other than Cade, but Cade told me 19.5 and I just said, yeah, like, so it might not be perfect, but that's what it means. Um, so okay, so that's how that's the market side of this. And I want to any other questions on the market, and then I want to talk about affordable housing and then social housing. And I'm taking too long, so I got to move faster. Okay. But send more questions if you have them. So affordable housing is both really similar and also really different. And we now have a pretty sophisticated system in the United States for building affordable housing. And I'm going to walk through how it works and tell you some of the weird things about it. And maybe some of you will know all of this, but it's sort of, when we talk about social housing, we have to compare it to the existing system of social housing, and we need it to be better. And we already have a system and it sort of works and it's got some downsides, but we have to be careful not to throw the baby out with the bathwater and just reproduce the same thing with new names and not have it be better. Um, so when I say affordable housing, what I'm talking about here is housing that has some kind of public subsidy in exchange for some kind of restricted rents, where the rents are, below market, they're affordable. That can be family housing is what we typically call it, though it doesn't always involve families, but just regular apartments. Senior housing, sometimes restricted just for seniors, but also at a below market price. Permanent supportive housing tends to be the term that we're now using for housing for very low income people that comes with not just shelter, but also support services. And special needs housing, sometimes it's housing for people with developmental disabilities or other specific needs, also tends to be subsidized. There's a lot of variations in there. There's also a lot of other things that might be affordable housing that aren't on one of these, in one of these boxes. But the bulk of what we're building, in terms of number of units, falls into one of these categories. And I'm not talking about homeless shelters here, and or mobile home parks are also sometimes affordable housing. Some focused on apartment buildings. Um, Affordable is this really tricky term. It Everybody wants it to mean something, it's like you know it when you see it. And a lot of times our affordable housing is really not very affordable. And it's really a question of who you are. Is it affordable to you or not? We call it affordable housing. That does not mean it's affordable to you. Um, so everyone has a slightly different amount that they can afford. And the standard that all of our government programs tend to use is 30% of your income for your rent, including utilities. And so some programs have slightly higher or slightly lower thresholds. Different people use different numbers for like what utilities will be. But basically, if a custodian earns $26,000 a year, a third of that is $650 a month, or 30% of that is $650 a month. A medical assistant might earn $41,000 a year, so that's $1,000 a month. The nurse earns a little more. The doctor earns, or the pharmacist earns enough that they could pay $2,900 a month, and that might even be above market for our new apartment building. Doctor's going to be able to afford to pay $4,000 a month. That's probably well above market for our new building. So, like, everybody has a different amount that they could pay. If we're going to charge a particular rent, it's not going to automatically be affordable to everybody. Um, Typically, the way we do it is we use the area median income. And so HUD in Washington publishes this number for every county and city, metro area in the country. It's a different number. It's based on an actual survey of people's actual income, and then there's all kinds of adjustments that they make. And it's different for different household sizes. And so, we talk about low income is people who earn less than 80% of the area median income. So in Davidson County, for a household with three people, that's $82,700. So we might have a unit that's restricted to 80% of AMI that can house three people, so that you have to earn less than $82,700 a year to live there. And another unit might be restricted to 30% of median income, and it's a single room unit. And so you have to earn less than $24,000 a year. Those are both affordable units. They're just targeted at different income levels. So one of the key challenges that we have is it's a lot easier to finance, and I'll show you how. It's a lot easier to finance the affordable units for the wealthier affordable people, the people with more income. And the further we go down that income spectrum, the harder it's going to be to come up with the money. Um, so, uh, if you take these incomes and we just multiply each of them by 30%, we get the affordable rents. So 80%. So this is an example of a one bedroom unit. So we typically assume two people in a one bedroom unit. So we take the two-person median income, we divide by 12 for months, and then we multiply by 30%, $1,800. A low income family could pay $1,800. A very low income family could pay $1,100, and an extremely low income person would pay, or family would pay 690. And below 30%, we tend to have vouchers or something else where it really is going to vary. The rent, they're going to pay a percentage of their income rather than fixed rent. Um, our costs, though, are going to be the same as they are for market rate building. There's some variation. The truth is, these days, affordable housing often costs more to build than market rate housing. One reason is labor standards and et cetera. Another reason is green building. Another reason is NIMBYs. We have to build to a pretty high standard when we're building affordable housing because neighbors come out and they oppose affordable housing. We have to show them that it's going to be really high quality. And that's in some sense a legacy of people in the 50s and 60s built kind of crappy affordable housing because they were trying to make it cheaper. And then there wasn't great neighbors, and people got this idea that affordable housing was going to push down property values. It doesn't. We see all over the country the affordable housing stock actually is bringing property values up in most cases. They're really well designed, but that comes at a cost. So we're held to a little bit higher standard. Um, but for this example, I'm just saying it costs the same 400,000 a unit to build our affordable unit. Um, where are we going to get that money? Again, we have this idea of debt and equity, and the debt is exactly the same thing. It's often a bank loan. Sometimes there's a special I put here competitive federal and state programs, but like sometimes there's a state program that will finance a loan for affordable housing. There's federal programs at HUD and other places that are like designed to help finance affordable housing. But often it's just the same banks that finance the market rate, the same people at the same banks. They're looking at the rents, they're looking at the construction costs, they just underwrite for affordable. On the equity side, though, it's completely different. Now we don't have the hedge fund and the pension fund. We have the low income housing tax credit, which I'm going to explain in a minute. And we have grants. So we might get a grant from the city or the state that's going to function in the same way as the hedge fund money. It's going to make that bank, like Bank of America is going to lend on our building, but they only want to lend 70% of the cost of the building. Where's the other 30% coming from? Well, we got a grant from the government. And they're like, okay, great. If for some reason we lose money, the grant's going to eat it. And we have the same safety that we would have had if you got it from a hedge fund or a pension fund. Um, we also sometimes have donated land. We have fee waivers that cities do. The developers of affordable housing will often do the work for a lower fee that so we get this sort of pile up of different sources that make up the same basic structure. So where the capital stack, oh, sorry, I'm going to show the capital stack in a minute. Where the capital stack for a market rate project is just a few sources, on an affordable project, it's sometimes dozens of different sources that have to be layered in to make the deal work. I'll show you an example of that in a minute. But the key thing I want to talk about here is just another one of these numbers, and this one is debt service coverage ratio. And you don't have to memorize any of these. It's just when you see it, you'll be like, oh yeah, well, that was the thing. This is the number that drives these affordable deals. And again, it's the net operating income. So it's how much money is going to be left over every month after we have paid for the cost of operating the building, divided by the mortgage payment. So how much mortgage can we borrow? Um, we can't really put all of the net operating income toward paying for a mortgage. So the debt service coverage ratio is how much cushion is there? And I'll show you what that means. So if we have a 80% AMI unit that's renting for $1,800 a month, and it costs us $700 a month in operating expenses, that means we have $1,100 left over that we could use to pay for a mortgage. But if I'm the bank and you tell me you have $1,100, I don't want your mortgage payment to be $1,100. I want you to have more than you need to pay me. So I'm only going to let you have a mortgage payment of $917. That's a debt coverage ratio of 1.2. And what that means is 1,100 is 1.2 times 917. So you have to have a little bit more than you need to. You got 1,100, you can only borrow so that your monthly mortgage payment is 917. You gotta, because there's going to be a 20% extra. You're going to have to bring in 20% more than you need to pay my mortgage. So that means you're going to have leftover money every month, which is great, but it limits how much you can borrow. And so at 7% interest, you can borrow $137,000 and your monthly payment would be $917. And so what that means is our rent determines how much money we can borrow. And if we have a 50% AMI unit and now instead of 1,800 a month, our rent is only 1,100, but our operating expenses are still 700, we only have 450 left over. And if we take 20% less than that, that's $375. $375 monthly payment is only enough that we could borrow $56,000. So even though we went from 80% down to 50%, which is, 30% lower, right? 30 percentage points lower, our mortgage that we can support dropped by to less than half. We're only able to borrow $56,000 instead of 137, and that's because the operating expenses stayed the same and ate up a bigger share of our rent. And what happens when we get to 30% of AMI is that the rent's lower than the operating expenses, and we have a negative net operating income. We can't borrow anything, and in fact, we need an annual subsidy to come in from a voucher or some other source to cover that loss, or we're not going to be able to do it. So we got no debt in that situation. Um, so what that means is that at 80% of AMI, if our unit costs 400,000 to build, we have to find another $262,000 to even be able to build it. That's our subsidy gap. We need more. We need to subsidize the tenant, the resident is paying rent that's enough to support a $137,000 unit, but the unit costs 400, so we have a gap of 262. And for a 50% AMI unit, our gap is $343,000. So, even more. So where are we going to get all that money? Kate, did you have a question?
Yeah, I have two quick ones.
I think
So
you're muted. Go
the
ahead.
first one is DSCR. Is that just basically debt to income ratio, but for mortgages and loans?
Yeah, it
Okay.
is. Exactly. Yeah, it's debt to income. The income is the operating income and the debt is the mortgage payment.
And
Yeah.
then secondly, real quick, are all units in a project generally the same percentage of median income? And if so, is that a requirement?
No. It's really common nowadays for there to be a mix, some lower, some higher. And what you really have to look at is like I'm showing you per unit numbers, but you can do this for the building. The total rent for the building is $8 million dollars, and the total operating expenses is 2 million, and the net is right. And the math is the same, but you've got a blend of some at this rent, some at this rent, and there's a range. And the more you put the lower income units in, the lower the total rent goes, the lower your net operating income goes, and the bigger your subsidy need is. So it's just the same, it gets sort of averaged. Boy, everybody's hanging through a lot of numbers here. Um, okay, so where do we get all this money? This is like I said, we have end up with a lot of different sources in an affordable housing project. So we have a handful of federal programs. The big one that finances the majority of our low-income housing these days is the low-income housing tax credit. We also spend a lot of money on vouchers through the what used to be called the Section 8 program. And the vouchers will subsidize the rent for the very lowest income tenants. We have special programs for people with AIDS, people who are homeless or formerly homeless, veterans. We have senior housing programs. We have a whole alphabet soup of federal housing programs. And then most states have some kind of programs. They have a state bond where they raise money, or they have some sort of state trust fund or housing finance program. There are states that have their own low-income housing tax credit. And then many cities will have their own, or counties also will have their own programs where they've raised money through some tax program, or they've issued bonds, which means they borrowed money that they're going to turn around and invest in affordable housing projects. They often have, I've listed here, community development block grants. This is really federal money that the cities will administer, but they can put into affordable housing project. Same thing with the home program, federal program, but cities decide where to spend it. More and more, we're seeing cities find surplus land and use the surplus land as a subsidy for affordable housing. So, I was showing $46,000 a unit in land cost in my example. If we built on an old city parking lot and we didn't have to replace the parking, that's like getting a grant of $46,000 a unit. It helps fill that $200,000 gap. It's not the whole thing, but it's a big piece of it, and it didn't really cost the city anything because they had this extra land. Um, and so let me walk through the low income housing tax credit. And this is another thing. If you had to take a test on this, I would feel bad for you. You don't have to take a test on this. It's not going to make any sense. It's the craziest thing that we do. I I I think it's important to go through how it works a little bit so you get a general idea. But but if you try to make it make sense, it's very hard. I've been doing it for decades, and I still scratch my head about like, why does it work this way? It's like we designed a program to keep the lawyers busy and to generate as much legal fees as possible. Um, but we've built 3 million homes. We've served 7 million low-income families with this program, and we shut down most of the other programs. And so this is the game in town. And don't go around talking ill about it because we can't afford to lose it. Um, if any of you ever, get a seat in the Senate and want to write legislation to design a better program, there's lots of better ways to do this. But until then, we just live with it. So the deal is the IRS will give a credit to taxpayers that own property that is qualified for the low income housing tax credit. And tax credit means if you owe taxes, you can pay them in cash or you can pay them with this credit. And I think the way people pictured it when they passed the legislation back in the Reagan administration was that, people would buy property and they would make it affordable and they would get this credit on their taxes. But instead, we've built this whole industry to sell these credits. And the way it works is it's not an unlimited credit. There's only a certain amount per year. And so the IRS doles out the right to hand out these credits to the states, and each state has a body that they've designated to receive the credits and set the rules. And then they award the credits to development projects. And they say, your project is going to provide affordable housing. We want two-bedroom units, or we want green buildings, or we want buildings in certain kind of neighborhoods. The state sets the rules for what kind of projects they're going to prioritize, and they have often a competition, and the top scoring proposal wins the right to the tax credits. The problem is that the housing developer, a lot of times they're a nonprofit, which means they don't ever pay taxes. So now this nonprofit just got the right to write off millions of dollars on their taxes, but they don't owe millions of dollars of taxes. And it turns out even if the housing developer is a for-profit, they don't owe millions of dollars in taxes. And so the credits aren't super valuable unless they're a, major global concern that's kind of diversified. It's not reliably going to be able to offset their taxes. And if you don't owe the taxes, the credits aren't worth anything and they actually get wasted. So what we do instead is we sell them to a syndicator. So imagine a nonprofit gets $5 million in tax credits. They turn around and they give them to a syndicator in exchange for $5 million in cash. And so the IRS didn't give the housing developer cash. They gave them something that they were able to exchange for $5 million in cash. And then the syndicator finds people or entities, more likely, that are likely to owe a lot of money on their tax return, and they sell the tax credits to them minus a fee. And so those tend to be banks, other big corporations that have predictably high tax bills, and they can buy $5 million worth of tax credits for $4 million. And so they then hand that $5 million over to the IRS when they file their income tax return, and it's worth $5 million to them. And so the whole system sort of moves these tax credits around in a way that results in money in that housing project that otherwise wouldn't be there. And the complaint about the lawyers is each one of these arrows is at least two different lawyers negotiating, at 600, $800 an hour, $1,000 an hour, each of these transactions. And there's fees all along, and the fees add up. And it would be a lot cheaper for the federal government just to put their money directly into the housing project. Kate,
Two questions if you have time for them. Okay, so the first one is though market rate and affordable housing are using mortgages, only the affordable housing focuses on what can be borrowed. Is this because of the low rental income, whereas with market rate the lender assumes there will be enough rent to cover the mortgage? Does this also make finding mortgage for affordable housing more difficult?
that's a great question. No, that's just a way that I've made it shorter. The debt service coverage ratio is just as relevant to the market rate project. It's how like I showed a certain amount of mortgage in there. I just didn't tell you how we got to that number, but we got to that number through the same kind of process. The thing that drives the feasibility on a market rate project tends to be the investors' demands, not the mortgage amount. On the affordable side, the mortgage amount drives how much subsidy we need, and so it winds up being a key variable. But the same math applies to both. For the banks are looking at the same numbers. Obviously, the higher your rent is, the more you can borrow. So it's easier to get a bigger loan for a market rate project, but the math is the same.
All right, then second smaller question. Is the thing you're talking about here on this slide the reason why affordable housing developers are usually huge national companies because they can actually use LIHTC as opposed to small local developers, which can't really use that tax credit?
Yeah, small local developers can use the tax credit. It just as much as this slide hurts your head, it's actually 10 times more complicated than this. And so the once you know how to do a tax credit project, you can do more of them, and you now have a specialized skill, and you get drawn into doing more of them because nobody knows how to do it. It's really hard to break in. So the small local developers are right to not start with the tax credit project because it's really complicated. It's why there's specialization, but it doesn't exactly require you to be a national developer. It just you need to do a bunch of deals. So you have to have more than like every small town can't have their own tax credit developer because it's too complicated. But theoretically, these syndicators make it possible for any small entity to do it. It would be very hard for the housing developers to, find all the tax credit investors and to manage it. And the other thing the syndicators do is they make it so that the bank or whatever can invest without having to spend a lot of time thinking about which projects are the best projects. They put their money into a pool that offers a certain kind of risk, and then the syndicator manages that pool and makes sure that all the projects fit that profile. And so they sort of act as the agent for the investors. And again, in a way that makes everything look the same. It's because the syndicators are using the same rules for everything. They all tend to look very similar because they're protecting the investor. Here, they're protecting the investor not from the risk that the rent is too low to cover their payments, because notice the investors aren't getting any of the rent. They're just getting these tax returns. What they're protecting the investors against is the risk that the project might no longer qualify for the tax credits. So if the tenants are above income or a host of other things happen, the investors could lose the tax credits, but they've already paid their $5 million, so they have risk, but it's a different kind of risk than the investors in the market rate project. And so there's like a compliance risk, and the syndicators impose a lot of compliance obligations, and that might be something that drives small developers out of the game. Like the property management company has to meet the standards of that syndicator to get the right paperwork from every tenant. And if you just don't get the right paperwork, you give dollars. So let me keep going. So here's just an example. Is actually of the have three times this many lines in the real deal, and you might not, but the biggest source would be the low income housing tax credits. And here I'm saying, well, we might get $128,000 per unit in tax credits, and instead of my just having one bank loan, well, it turns out I can borrow at a reduced rate from the state, but there's a limit to how much I can borrow. So I get as much as I can, but then I also need to borrow from the city a second amount. And then maybe there's a county fund too, and I borrow from that. And so my debt is actually not just one line, but several different lines. And then I have grants from other sources that are in there. And, so it's like, and some of the, so see where I have the word soft debt, some of the debt is actually acts like grants that we're not making payments. We owe the money back someday, but we don't have monthly payments on it. And so there's just like different rules for different programs, and we're going to piece them all together to raise the $20 million that we need for this project. And so the feasibility of the project is first and foremost, can we get the tax credits? Because without the tax credits, we wouldn't have a project here because it'd be too much money. And then can we piece together the rest of the terms? It makes it really hard to say, yes, this is feasible or no, it's not, because it's sort of like somebody's going to go out and try to raise money and we're just going to see how far they get. Um, Okay, I'm going to pause there. Are there questions about how affordable housing works and how it's similar or different from market rate housing?
Yeah, so we have one question so far, and maybe a few more coming in. But someone pointed out that in Nashville, we have about $15 million in city grants without any dedicated funding to fund those. And the person is wondering how much in city grants comparative cities to our size give out every year. And like what should we expect sort of on the policy level for that as far as dedicated funding or just amount?
I don't know that off the top of my head. There's a huge range in uh, how much cities have invest in affordable housing. Some cities have a lot of programs and they've come up with a dedicated source every year money. And other cities have nothing and they just pass through the federal money and that's their whole contribution. And so if you have a local source at all, that's great. And one of the best things you can do as an advocate is, help your city see that it makes sense to have their own program and to come up with some money. And that's great both because the city, then now there's another source, and that's great. But it's also great because when you look at the state and the federal programs, there's often a competition for resources, and the cities that have the most generous local programs are more likely to win. So having your own local source of money improves your odds of bringing in that outside money, and so it multiplies. Every dollar of local money you put in, you bring in $4 to $9 of outside money. And so it's a good return for a city to put a little bit of money into subsidy for affordable housing.
Great. We don't have any other questions at this point. So
Great. Well, I'm almost done. I want to talk about social housing last, and I have the least to say about it because it's the newest idea. And I want to start by saying the term social housing has been around for a really long time and has always meant different things to different people. In Europe, they use the term social housing to talk about um, uh, the things that we've just been talking about as affordable housing would be described as social housing in a lot of Europe. And I think are accurately described here as social housing. Like a community organization buys a building, rents it as affordable, that's social housing. In the American context recently, though, what I think most people are talking about when they say social housing is housing that looks like the kind of social housing they do in Vienna, or in other places in Europe as well, where we have a mixed income building that's developed by a social housing developer, like a public developer, rather than a for-profit developer. So our system, the market rate housing is all built for profit by for-profit developers, and the affordable housing is mostly all built by public agencies, nonprofit organizations, and sometimes for-profit builders, but then it's operated on a nonprofit basis, and they're two separate things. And social housing is, well, what if we had a building and we could use the profits from the market rate units to subsidize the affordable units, and we could just sort of internalize that subsidy a little bit. And what if instead of paying Wall Street 25% return on their money, we put public money in and took the sort of profit out of it and had a public developer that could build mixed income buildings. And message Kate if that's not what if you sort of see a variation on that. There's a every city in America that's doing social housing is doing something slightly different, and they're not financed the same way, and there's not a model that's the one model. And so I'm just going to show you at the sort of highest level how the projects we've just been talking about might look if we did it differently. But I'm not suggesting if you do social housing in Nashville, it'll work exactly like this. You should spend the time to think through what are the best ways to do it. And um, but I think there's some sort of fundamentals that are similar. Um, so the first thing I want to point out is that we actually need more market rate, kind of middle income housing, right? The market, because housing supply has been constrained so much in so much of America, the market has tended to build really high-end housing for the last 4 decades. But if you go back to when we were sprawling out into the suburbs, a lot of the housing that got built was actually middle income housing. And we've stopped doing that because the if you only get to build 100 units, a year, you're going to build the most expensive ones. But if we're going to build at a higher volume, it makes sense to build for everybody or for, toward the middle of the market. So one of the things that people want sometimes out of social housing is actually just more market rate, middle income, more market rate housing that's less expensive, right? It's not affordable housing, it's not below market, but it's just not as pricey. We also need a way to subsidize more low-income housing. Like we basically build as much low-income housing as we have subsidy for. And we can tinker with the engineering all we want. We don't get more affordable housing unless we put up more money. But the idea behind social housing is that somehow when we build, if we create a public entity that can build more of this middle income housing, we can also use it as an engine to subsidize more low income housing. So we can get more of both from one investment, one project. And that's a thing that's really easy to say, and it's true, but it's only somewhat true. And so the tricky part here is like how much can we really count on market rate units to subsidize lower income units? And particularly if we want those market rate units themselves to be kind of modest priced, the more modestly priced they are, the less they can subsidize other projects or other units. So there's some trade-offs, like Christina was saying at the beginning, and then if we want it to be green building and we want to build with like union labor, we're going to have costs. We're also going to reduce the amount of subsidy we have for affordable housing. So we're going to have trade-offs we're going to have to manage. So this is the slide I showed before. This is our market rate project, 50 units, $20 million project. The bank loan is there, but a lot of the money is coming from these uh, high return investors. And to turn it into a social housing project, we basically zero out the investor money. We don't take the Wall Street money. We don't have a private developer put their own money in. Instead, some public agency puts up $5.5 million dollars. So that's $110,000 a unit. That's a lot of money. But we build our $20 million project with public money instead of public equity instead of private equity. Now, a lot of the difference between the different social housing models is comes right here. Like, well, do we really do that, or do we do some variation on that, or are there layers here? But just to really simplify it, the basic idea is let's get rid of the high cost money and let's use public money instead. And instead of having a profit motivated developer, let's have a public entity take on the development risk and manage the development. And I want to point out that that doesn't necessarily mean there's not a private company involved. There might very well be one of the exact same companies that does the market rate real estate development in the deal, but they're in the deal as a contractor. So where we, the public agency, might hire a real estate developer to build a project for us, and instead of putting their own money in and having taking a lot of the risk themselves, we might supervise them. We might have them be, essentially our agent and do the deal for a fixed fee, for a fixed price, the way we would hire a general contractor. And then there's hybrids where we might actually have them put some money in and take some risk. The more they're the more return they're going to want, and the less we're doing social housing, and the more we're doing government subsidized market rate housing. But that's the design question in social housing. Um, Still, though, we have the same problem of how much can we borrow? Like we'd like to borrow as much money as possible. And this slide that I'm showing here is a little bit misleading because I'm showing the same $14.5 million in bank mortgage, but actually it's going to have to go down because we're going to also include some affordable units, right? So, if we have a market rate unit can support $263 of $263,000 in debt, and the affordable at 50% AMI unit can only afford $56,000. The more affordable units we put in the building, the less debt we're going to be able to support. So I'm not going to show all the math behind this, but um, if we eliminate the need to pay the developer profit, we save some money. And if we have that public debt at no annual cost, so we're just some public agency puts the money up and we're not making payments on it, we can do 30% of the units at low or very low income level and still have the same basic bank mortgage. Um, there's a million options here too, right? Maybe we're not getting that money for free. Maybe we're making a 3% annual payment on it. That means we have to borrow less money from the bank. So we need a bigger amount of public money to begin with. So there's options and variations. But the basic idea is that we can get some affordable units just by not having to pay for that public money. Having low cost or free public money allows us to lower the rents on some units, but it doesn't let us do a whole building that's low income. Kate, question.
Yeah, generally, are we as a municipal government able to take out larger mortgages due to like the trust or like I guess like uh ability to
Yeah.
like pay that back or trustworthiness of a local government?
Yes, and that's what we call bond financing generally. So what can happen is, if you want, a local government can issue a bond, and like this is how we pay for parks, for example. We go out and we borrow money from the capital markets based on the sort of tax revenue that a city has, and we say we have this much taxes. We want to borrow this many millions of dollars. We're going to use it to build parks or schools or whatever, and we're going to pay it back over 30 or 40 years, this much per year. And they sort of look at the tax revenue and say, yeah, that's probably going to be okay. You're not overextended. You can do that, and you can have a general obligation bond that says we're just going to use it just like a park. We're going to just pay for it out of our annual city budget. Or you can have a special purpose bond where it's like we have a source of revenue. We're going to adopt a special tax on hotels. And every hotel night is going to pay us $5 toward this tax. And we're going to generate this many million dollars a year in taxes. And we're going to use that money to pay back a bond. And we're going to use the bonds to finance social housing. And so you can borrow money against some special revenue and not have it be coming out of your general budget, but it's segregated. Um, and under both of those cases, you get a pretty good interest rate because the government presumably pays its bills. Um, but even if you have to go to a bank, if you have a social housing developer, they have to have somebody backing them in order to get the bank mortgage, and the public agency either has to explicitly guarantee that or implicitly, like say, oh, we're part of this. It's a part of local government. So, if for some reason they go bankrupt, we'll cover their debts. So the presence of the local government agency in the deal makes a difference to the bank. And exactly how they're in the deal is really important to the financing. Are they really on the hook or are they just kind of politically on the hook? But even just being politically on the hook is worth something. Um, a couple more things, and I'll stop and take more questions. So if you have more questions, send them to Cade now. Um, that doesn't get us to very deep affordability. And so one of the questions that people in Chicago had was, well, how can we do this social housing but get housing for people at 30% or lower of area median income? Or, how can we get down to the families that really have the acute housing needs? And I don't think you can just do financial engineering to serve that population at any scale. The rents are really low and the, subsidy sources that you need are really high. And so what we do generally is we use vouchers. And the problem is vouchers are limited, but when we get vouchers, what you do is you take a tenant and the tenant pays $300 a month or $150 a month or like what they can afford to pay. And then the HUD pays the difference between that and what they call the fair market rent, which might be $1,800 a month or $2,000 a month. So the building gets $2,000 a month worth of revenue, and it looks like a market rate unit. And so from the building side, we get market rate units. And from the occupancy side, we get very low income tenants. So the more we can put project-based Section 8 vouchers, or project-based vouchers into buildings like this, the more deeply affordable we can get. You have to have your housing authority in the deal. They have to have the vouchers to give. There's a limit to how many project-based vouchers they can invest. But in a social housing context, sometimes it's hard for them to find places to put the vouchers. And it's a great way to push down the affordability levels. But again, it's capped. There's only so many we're going to get. So if we scale this idea, we're going to run out of vouchers. We're not going to be able to do it in every building. But for the first few buildings, it's actually a pretty simple way to add some deeper affordability. After that, we start having to make real trade-offs. So we're going to get grant money maybe, but we could use the same grant money to help more families. Do we want to lower the affordability of the units and have fewer units, or do we want to have more units but have them be at a higher income? This is a trade-off you just can't get around. We could have 30% of the units at 80% of AMI, or 20% at 50% of AMI, or 5% at 30% of AMI. They might all be equivalent. But like if you build a building and it's 95% market rate, are you going to feel like it was worth the trouble to create a social housing entity? Um, if so, everybody has a different opinion about this, but there's really I was going to say there's no way around that. There is a way around that. Vouchers are the way around that. After you run out of vouchers, there's no way around that trade-off. It's just the deeper the affordability, the more it costs, the fewer units you can do for the same amount of public money. You come up with more public money, you can do more units, but you could also do deeper affordability. Um, the key question for a lot of the social housing projects programs is how much does the city want to recapture its investment, or is the city money a grant? Is it just going in the deal and not getting repaid, or is it being repaid, or is it being repaid eventually, but not during the first 10 years? Like the more the city expects to get money back, the less affordability there is to play with. Um, I sort of already mentioned this several times, but it's just obvious, I think, that also all of the other social goals you might have come with costs, and each of those costs reduces the amount of money that's available to provide subsidies for affordable units. And so, you know, there's some debate about how much labor standards will drive costs, but to some extent. Environmental and green building, starting to get pretty normal, still makes building slightly more expensive. How effective and responsive the property management company is a cost. The good property managers cost more money than the bad ones. And if you're running a social housing venture, you really want to hold yourself to a high standard, but that's going to cost some money. Same thing with tenant governance. It's been important in a lot of these conversations to have these buildings have a place for the low-income tenants to participate in how the buildings are run. That's not free. It's not super expensive, but it doesn't just happen because you want it to. Okay, that's all I have to say on social housing, and I'm going to stop here and see, Christina, did you want to add anything, or then we can take questions? Oh, is she there?
She's there, but she's not unmuted, and she is driving or in a car.
Okay.
I
Well,
need to
let's.
can you unmute, Christina? I might have muted you,
Okay,
huh?
she's driving. Kate, have you received questions we could answer?
Yeah.
Sorry, I'm here. Wait,
Oh, that's fine.
I've been unmuted.
Huh.
Okay. Um, because I switched to my phone, I wasn't able to unmute without some intervention from you all. But I think I just wanted to convey the tough choice that the Chicago folks had to make. So they negotiated to have more market rate units, so more units that were for, like, honestly, like, to me, the price of the rents was very high, but because one of the big focuses was like, there's a certain percentage of people who are unable to make rent payments, and we want to like cater to them, and we want to make sure that there is housing being built because otherwise no one's building housing for those folks that's like truly high quality. The other thing I wanted to say is that in the case of Chicago is like if you're thinking about a city program, um, sometimes the city program you need to build in lots of different neighborhoods because there's need in lots of different neighborhoods. In the case of the Chicago model, that model didn't pencil out in every single neighborhood. And the neighborhoods where it didn't pencil out was neighborhoods that were predominantly neighborhoods of color. Um, so it's like, it was a hard thing for the coalition to sort of back this model when some of the places that the coalition members were living in weren't going to see social housing for 10 or 20 years. Um, and the way they're going to go about doing this is like uh, they're going to acquire new units or like existing units and put them in the portfolio and be able to like over time build up the portfolio for lots of different neighborhoods. But I just want to say like, yeah, making all of this pencil out for everybody in every place, like it's tough. So it's just a sort of thing that it's a balancing thing that policymakers will have to consider. Um, you know, so
And
anyway,
to
that's what I would
kind of
add.
tie it back to the presentation, the reason it didn't pencil out in every neighborhood is the market rents were lower in some neighborhoods than others. And so as you move across town into places with lower rents, the amount you can borrow drops because the average, the total rental income goes down, so the NOI goes down. So you get a smaller mortgage and you need more subsidy, and they had a cap on how much the city was going to put in. And so that cap implied a map. These are the places in town where you can do it with that much, and everywhere else you would need more.
Just really quick, because I know some people are going to hop off. I just want to say tomorrow in our monthly meeting, we're going to go over sort of what we've been working on in a coalition on social housing. For those, because I see the numbers already kind of, so I wanted to hop in there. So please come to our monthly meeting. I think Cade has already put the thing in the chat, and now I will shut up and Cade, you can.
Yeah, I just want to make sure. Christina, did you say everything you wanted to say, or were you still going? You're good. Okay, cool. Um, Someone asked, what about using tenant-based vouchers? Nashville currently has less than 900 project-based vouchers available.
Yeah, that's really common. Yeah, you can use tenant-based vouchers. And like a sensible thing that I imagine most of these social housing entities will do is make sure that anyone with a tenant-based voucher can rent one of the market rate units, and that there's some complexities to that, but um, in some cities it's actually hard to find market rate buildings that will take vouchers, and if you control the entity, you can control that choice and take the vouchers. What that does, though, into your coalition politics, though, is it means you're taking a gamble on whether the tenants are going to be low income or not. You're building a building and you're saying, yeah, and maybe some tenants will come along later and have vouchers. And so we'll get more like this building's going to be 30% affordable. Maybe there'll be some tenant vouchers also. But you can't guarantee that because you don't know if there'll be tenants with vouchers that will choose to live in the building. If the tenant can take the voucher anywhere, they may not choose that building.
Great. There were a few questions about this, so I'm going to try to combine them. Basically, there were some questions about using AMI, and if there's any way around using AMI to set. I think specifically for Nashville, some folks pointed out that we have Williamson County involved in, or like, which is one of the richest counties in America in our AMI, which very much skews ours. Um, yeah, any way around using AMI or ways of addressing that if there's no other way around it.
Yeah, there's not really a way around it, but but there's a way to get around um the concern that you have without getting around AMI, which is that if you're a lot of times cities will calculate their own local AMI, like just inside the city of Nashville median income, and it'll be like a much lower number than the HUD AMI because it doesn't include the surrounding wealthy communities. And so let's say it was half, which I don't know what it would be in Nashville, but um, if you wanted to use your own number, you'd create all kinds of regulatory headaches that would make it almost impossible to operate and to layer the subsidies, et cetera. But if instead of renting at 80% of AMI, you rented at 40% of AMI, that would be the same as renting at 80% of your local median. So this is just it's an arbitrary metric for like how deeply affordable is your building. Just because some HUD program says you have to be at 80% or below does not mean your units have to be priced at 80%. So if the median income is too high for the people you want to serve people at a lower percentage of median income. And that's just this, like you're not dependent on whether the median income accurately reflects who lives in your community. You want the rent to accurately reflect what people that you're trying to serve can afford to pay. Um, and it's, in a community that has a lot of wealthy people, like out here in California, we have Marin County, and it really skews the incomes, but like your affordable housing just can't be at 80%. I mean, it has to be much deeper. It's still the same people that like in Oakland are, at 80% of median. But in Marin, those people earn 40% of median because it's a different market.
Great. Someone said, I know with disability and other federal programs, one of the issues people face is being kicked off when their income changes. A lot of times these programs help people achieve income stability, and then getting a new job or something else will get them kicked off. I'm wondering if there's a way around like having units set at AMI remain consistent if people's income changes.
Yeah, this is actually that's like a down in the weeds issue, but it really is the kind of thing you can change here. So when you use something like the federal low-income housing tax credit, you're stuck with all kinds of rules about what happens when people's income changes and how long they have before they have to move if they go over income or, and the federal government basically decides all of that. When you create your own social housing program, if you're not using the tax credits and you don't use a whole bunch of other affordable housing programs, you don't already have rules about that. So you can set whatever rules make sense in your community. And there's nothing that requires that you care at all about income after they move in, if that's what you want. So you could decide that people have to income qualify when they move in and never again. And their income's just what it is. Or you could say, we really care about that a lot because if people move in and their income goes up, now they're taking up in a low income unit, they're getting a discounted rent, and somebody who needs it could be using that. We want that unit to be available for low income people. That's the decision the federal government already made for you in the tax credit program, but you can make that decision yourself. Do you want more turnover and more opportunities for people who really need it, or do you want people to have stability and security and be able to stay even if maybe they could afford to pay more? You can also have their rent go up when they can afford to pay more and offer someone else a lower rent down the road. So like you become the management and you can make those decisions yourself. If you start to layer in other affordable housing programs, you lose some of that flexibility.
Gotcha. All right, last one I have currently. So y'all, if you have more questions, please. Oh, actually, I have one more after this. But this is a similar question. Someone asked, can you change the percentage like of, I guess, affordable units over time or the amount of AMI over time? For example, if the city paid off all its debt, would you then be able to expand this after a certain point in time?
Yes, the answer is yes, you can. Um, but again, there's going to be a whole bunch of trade-offs to that. What happens is as the building pays off its debt, it's also like typically 30 years old, and at a certain point it needs to be renovated. And generally, that's why the mortgages are 30 years, because that's when it needs to be renovated. And so just when you pay off your debt, you end up needing to borrow more money to rehab the whole building, put new kitchens in everywhere, and you end up maybe not exactly where you were before, but like it's not as great as it seems like it will be when you have no more debt. Because you end up borrowing again. But I would say over the long run, um, social housing, if it's done properly and well managed, should get more affordable over time. There should be you should be you should be able to have the rents be lower. The market rents and the affordable rents should be able to get lower over time, just not by some magic huge amount.
Gotcha. And the last one I have currently in the queue is someone wanted to know sort of the relationship or the ability of social housing programs to sort of combat large companies having monopolies over properties. I think they mentioned specifically Blackstone buying up properties and inflating prices. I know also Real Pages here in Nashville. There's currently a lawsuit against them of artificially inflating. Can you just sort of talk about I guess specifically how a program like social housing could also lead to deflation of rents in the overall housing market.
That's a great question. Yeah, I mean that's the big picture game, right? You really need to have a very well established social housing entity, and you need to do a measurable percentage of the total housing before you can have that kind of clout. But we see in communities that have high shares of affordable housing that even that helps moderate market rate rents because it just, there's just that many fewer people looking for market rate units. As the social housing stock grows, if you really are able to offer middle income units at market rates, that puts downward pressure on the um, rent that they can get in the market rate, the private market rate units. Um, Even if you leave aside the sort of informational collusion where they might be misrepresenting the rents to get higher rents or whatever, the just the raw actual market power of if you have a lot of units in social housing, that should help push down prices. The other thing that's important is you build more. If you can build, like we were talking about, if you can build housing during the times when the market isn't able to build housing, you're going to end up with more supply, and that's going to push rents down across the market too. Just adding extra market rate housing units will lower everybody's rent in the whole metro. It's not going to bring it down to an affordable level, but it's going to put downward pressure on the market rents. And that's an intent here. Like that's the idea. It's like let's come up with a better way to get more supply than just like let's give Wall Street 20% return every year to get us out of this hole.
Great. Can you also explain how a social housing program that uses a revolving loan fund and bonds pay themselves off and how developers would pay the city back?
Yeah. So if you structure the public investment as debt, right, and you're going to pay yourself back, you you end up borrowing less money, so you need more of it. So like instead of the $5 million I was showing, you might need 10 million because your bank loan's going to get smaller because you're going to have less money every month available to pay the bank loan. So you basically take out the payment, you've got your net operating income, and then you're going to take out the money you used to pay off the public debt, and what's left over is what's available for the private mortgage. And the more you pay for that public debt, the less there is left over for that private mortgage. So it gets smaller and the amount of money you need from the public source gets bigger. And it's kind of that simple. And so you absolutely can set it up as a revolving loan fund. Ideally, it's a below market rate loan, or else it's really not helping that much. But if it's a below market rate loan, you can get money back. The other thing that I suspect someone will do is a loan that's deferred. It's still a loan, so it's a revolving fund, but we're putting $5 million into this project, and it's just going to sit there. There's not going to be monthly payments, but at some point in the future, we're going to refinance the building and we're going to get paid back. We're going to get the public money out and have it be 100% debt financed, but not when it's brand new, because the rents are going to have to go up first. If the rents go up enough on the market rate units, we might be able to refinance it so that we get the public money out and use it on another building. I'm going to point out that that's the same money we were just talking about using to make the units more affordable. But over time, there's more flexibility. So I think a good option for social housing is put money in, leave it in for 20 years, try to take it out after 20 years or 15 years.
Got you. And then finally, because I know we're coming up on time here, had a few questions about currently the way we fund affordable housing within the city, which is for us called the Barnes Fund, which is basically a fund that the city puts money into that is used sort of as subsidies to nonprofit developers, et cetera. Can you sort of talk about what
Yeah.
the advantage of a social housing model where the city retains equity or ownership in the buildings, like what the advantage of that is versus just giving that money to like a nonprofit developer?
Yeah, my opinion is that the advantages are not enormous. That nonprofit developers mostly do a really good job, and where they don't, the cities have the tools to make them do a good job and to hold them accountable. And so, when you create a social housing entity, it might be a public agency, but it's going to act a lot like a nonprofit housing developer. It's going to have its own staff and probably its own board, and you're going to need it to be a little bit separate from city government, just because the risks of housing development are big.